I just want to quickly get your reaction to some of these lines coming through from San Francisco Fed President Williams. Do you anticipate that this unwinding of the balance sheet will happen later this year, and will it be as smooth or, I quote, boring as clearly Fed members want it to be?
Well, both they and as well as us certainly hope that's correct. JPMorgan's expecting about $1.3 to $1.5 trillion reduction in the Fed balance sheet between now and 2020. And the key, as the governors are now saying, is absolutely signaling. If the market understands this in advance and it's effectively priced into rates in advance of the unwind, then we think we're in pretty good shape. It's effectively the equivalent of an additional 25 basis point rate hike. And it really all comes down to signaling and baking that information into the market in advance of the actual moves.
We're looking ahead, of course, to US jobs at the end of this week. That's expected to come in fairly robust and certainly not lessening expectations that the Fed will go in June. What would happen between now and then to prevent the Fed from being too high, to be able to change these expectations? And, are we still thinking about when this infrastructure, reflation, fiscal policy, certainty is going to come through from the Trump administration?
So you have seen some weakness in the data as we've worked through the first half of the year. I think you'd have to see that trail down significantly worse than what we've already seen to avoid a rate hike in a couple of months, which is what the market as well as JPMorgan has in its forecasts. I think the key thing for us in the U.S., and one of the reasons why, frankly, we're overweight emerging markets in Europe relative to the U.S., is the fact that aggressive fiscal impetus appears unlikely given the gridlock we're likely to see given politics in Washington right now.
We were talking just in the break about, this sort of, I guess, two paths of the reflation trade. Is it the case that the reflation trade driven in the US is something entirely different to the fundamentals that you're seeing outside of the US, in Europe and also in emerging Asia?
The biggest impact from the reflation trade here in Asia is really the impact that inflation has on nominal GDP growth, which is the biggest precursor of corporate profitability. And so as you see nominal growth in China, as an example, pick up, we are seeing a very strong resurgence of corporate profits, which make us significantly more positive both on the financial system in China on a short to medium term basis, as well as the overall economic outlook.
Talk to me quickly about oil, because we've had a little bit of a rebound, a recovery after that, horrid sell-off post-OPEC, really kind of selling the fact, I guess, as we'd sort of been bracing for going into that decision. Do you think compliance is going to be an issue, and does that kind of change your outlook over the next 6 to 12 months when it comes to oil and oil-sensitive economies?
It does, and we're looking actually for a breakdown in the agreement by the end of this year. We've just taken down our 2018 oil target by $10 to 44 US dollars. And so we do see difficulty in that space, and it's largely off the resurgence of supply coming out of the U.S. and the shale community. And so I think we have to be very careful with how we think about both the ongoing aspects of the reflation trade, which we think are very limited, and so we're starting to be far more selective in our country and sector stock selection as a result of that.